Hello there, my friend. Today, we're walking you through 8 investment tips you absolutely cannot afford to ignore. Okay? From understanding what investing actually means to building wealth that lasts for generations, mastering the psychology of money, avoiding the traps that destroy portfolios, and showing you what it takes to think like the world's most successful investors. Welcome to Alux, the place where future billionaires come to get inspired. Alright, so let's start off with investment tip number 1, understanding what investing really is. Because Aluxa, most people who try to invest, they often waste years throwing money at things they don't understand. If you want your money to actually work for you, you need to know what investing means and how it's different from everything else people do with their money. So grab a pen and paper, my friend, because by the end of this segment, you'll know the difference between investing, saving, and gambling, how to think about risk the right way, and why time is your greatest advantage when it comes to building wealth. Aluxa, most people who say they want to invest never actually do. And the ones who try often waste years putting money into things they don't understand. And that's because they either chase hot tips, copy what their friends are doing, or dive into markets they know nothing about. If you want your money to work for you, you need to understand what investing actually is and how it differs from everything else. Okay? So grab your pen and paper, my friend, because here's our promise. By the end of this video, you'll know what investing really means, how to separate good investments from bad ones, and how to start building wealth that compounds over time. Alright, so you want to invest your money and make it grow. Of course you do. If you're thinking it's as simple as buying whatever's trending on social media, well, think again, okay? Because that approach almost always backfires. Like when people see something like crypto trending, they think, I'll throw money at it without knowing the first thing about how it works. Or worse, they end up losing their savings on some pump and dump scheme that promised quick returns. But maybe they go in the opposite direction. They say, well, I'll just keep my money in a savings account because that's safe. And then they're crushed when inflation eats away at their purchasing power year after year. The problem is, most people never really think about what investing actually means. They either gamble on things they don't understand, or they're so scared of losing money that they never take any risk at all. But what if there was a way to avoid those traps? What if you could understand the real difference between investing, saving, and gambling? Well, my friend, that's where we need to start. Let's break down what investing actually is. At its core, investing is putting your money to work so it generates more money over time. It's not about getting rich quick, it's about letting your wealth compound. Think about it like planting a tree. You don't plant a seed today and expect fruit tomorrow. You water it, you give it time, and eventually it grows into something that produces value year after year. That's what real investing looks like. Now contrast that with saving. Saving is important, don't get us wrong, but saving is just setting money aside. It sits there, maybe earning a tiny bit of interest, but it's not growing in any meaningful way. In fact, with inflation running at 2 or 3% a year, money sitting in a savings account is actually losing value over time. Then there's gambling. And look, gambling isn't necessarily bad if you know that's what you're doing. But too many people gamble and call it investing. They buy a stock because someone on Twitter said it's going to the moon. They put money into something they don't understand because they heard someone made a fortune doing it. That's not investing. That's hoping you get lucky. Real investing is different. It's about understanding what you're putting your money into, why it has value, and how it's likely to grow over time. It's about managing risk intelligently, not avoiding it completely. Because here's the thing, Aluxa, risk is not your enemy. Unmanaged risk is. Every investment carries some level of risk. Stocks can go down, real estate markets can crash, businesses can fail, but the key is understanding the risk you're taking and making sure you're compensated for it. If you take a big risk, you should have the potential for a big reward. If you take a small risk, expect a smaller return. The worst thing you can do is take a big risk without understanding it and then act surprised when things go wrong. So ask yourself, do I understand what I'm investing in? Do I know why it might grow? Am I comfortable with the risk I'm taking? If you can answer yes to those questions, you're already ahead of most people. Now, the second thing you need to understand about investing is the power of time. You see, when most people think about getting rich, they imagine making one big score, finding that stock that goes up 1,000%, buying that property that doubles in value overnight. But that's not how wealth is built. Wealth is built through compounding. And compounding is what happens when your returns start generating their own returns. Let's say you invest $10,000 and it grows by 10% in the first year. That's an extra $1,000. But in the second year, you're not just earning 10% on your original $10,000. You're earning 10% on $11,000. The next year, it's on $12,100, and so on. Over time, those numbers start to explode. That's the magic of compounding. And the longer you let it work, the more powerful it becomes. Warren Buffett, one of the greatest investors of all time, didn't make most of his wealth until after he turned 50. Not because he suddenly got smarter, but because he'd been investing for decades and compounding had done its job. Time is your greatest advantage when it comes to investing. The earlier you start, the more you benefit. Even small amounts invested consistently over time can turn into life-changing wealth, so don't wait for the perfect moment. Don't wait until you have a huge sum of money. Start now with what you have, because every year you delay is a year of compounding you'll never get back. All right, so that's investment tip number 1. Understand what investing really is. Know the difference between investing, saving, and gambling. Manage your risk intelligently, and let time work in your favor. Now that you know what investing is, there's another problem waiting for you. And if you don't solve it early, it'll cost you a fortune. You see, most people lose money investing, but it's not because they picked bad investments. It's because they let their emotions make decisions for them. Fear, greed, impatience, these are the enemies of wealth. And to succeed as an investor, you have to master them. This is where investment tip number 2 comes in, mastering the psychology of money. You know, the stock market is a fascinating place because it's one of the few areas in life where being smart doesn't guarantee success. You can have a genius-level IQ, understand every financial metric, and still lose everything. Why? Because investing isn't just about numbers, it's about behavior. The best investors in the world aren't necessarily the smartest. They're the ones who can control their emotions when everyone else is panicking. Think about what happens during a market crash. Stocks are plummeting, the news is full of doom and gloom, everyone's selling. And in that moment, your brain is screaming at you to sell too, to get out before you lose everything. But here's the thing, that's exactly when you should be buying. When everyone else is terrified, that's when the best opportunities appear. Warren Buffett has a famous saying, "Be fearful when others are greedy and greedy when others are fearful." Sounds simple, right? But it's incredibly hard to do because it requires you to act against your instincts. When the market is crashing and your portfolio is down 30%, every fiber of your being wants to sell. But if you do, you lock in those losses. You turn a temporary decline into a permanent one. On the flip side, when the market is soaring and everyone's making money, it feels safe to jump in. But that's often when things are most dangerous. Prices are inflated, valuations don't make sense, and you're buying at the peak right before the crash. So how do you avoid these traps? The first step is recognizing that your emotions are going to try to sabotage you. Fear will tell you to sell at the bottom. Greed will tell you to buy at the top. Impatience will tell you to abandon a good investment because it's not moving fast enough. Once you're aware of these emotional triggers, you can start to counteract them. One of the best ways to do this is by having a plan and sticking to it no matter what. Decide in advance what you're going to invest in, how much, and for how long. Then when the market goes crazy, you don't have to make decisions in the heat of the moment. You just follow your plan. Another key is to zoom out. When you're checking your portfolio every day, every little movement feels huge. But if you zoom out and look at the long-term trend, you'll see that markets go up over time. Yes, there are crashes. Yes, there are corrections. But over decades, the trajectory is upward. The investors who win are the ones who can ignore the short-term noise and stay focused on the long-term picture. Think about it like this. If you planted a tree in your backyard, would you dig it up every week to check if the roots are growing? Of course not. You'd leave it alone and let it do its thing. The same applies to investing. Stop checking your portfolio every day. Stop reacting to every headline. Just let your investments grow. Now, there's another psychological trap that destroys investors, and that's overconfidence. You see, when people have a few winning trades, they start to think they've figured it out. They think they're smarter than the market. And that's when they take bigger risks, make bolder bets, and eventually lose everything. The market has a way of humbling people. Just when you think you've got it all figured out, it'll throw you a curveball. The best investors stay humble. They know that no one can predict the future. They know that luck plays a role, and they know that the moment they get cocky is the moment they're most vulnerable. So, investment tip number 2 is this. Master the psychology of money. Recognize your emotional triggers. Have a plan and stick to it. Zoom out and focus on the long term, and stay humble, because at the end of the day, investing is as much about controlling yourself as it is about picking the right assets. Alright, so now that you understand what investing is and how to manage your emotions, let's move on to investment tip number 3.